All right, it is 11 a.m. Central Time, so we'll go ahead and get started with our presentation today. My name is David Lindgren. I am a Senior Manager at Flexible Benefits Service Corporation, overseeing our Compliance and Public Affairs Division. Today's presentation is entitled Evolving Your FSA, the impacts from the Affordable Care Act, how the FSA is integrated with other products, reviewing some market trends, and more. Just a few housekeeping items before we get started. In order to eliminate background noise, we have muted all phone lines and will not be opening them up during today's webinar. If you have questions at any point, feel free to use the chat function. If time allows, I will attempt to answer as many of those questions as I can at the end of the presentation. For those that are looking for continuing education credits, today's presentation has been approved for one general HRCI recertification credit, as well as one SHRM professional development credit. In order for you to receive credit, we do need you to remain on the webinar for the duration of the presentation. And for those of you that do qualify for the credit, we will send you a certificate of completion via email within 2 to 3 business days. We will include a copy of today's presentation in that email. With that, you're going to go ahead and get started with a little bit of background information about our organization, just to give you some details about what we do and what market spaces we serve. Our full name is Flexible Benefits Service Corporation. We go by Flex for short. On September 1st, we actually just celebrated our 27th anniversary of being in business. Located in Rosemont, Illinois, a suburb of Chicago, we have approximately 75 employees, and we have 3 primary business segments. We are a general agency, a benefits administrator, and we also operate an insurance exchange and marketplace. Our general agency business segment, we operate at a wholesale insurance level, or I should say a wholesale insurance producer, contracting with insurance agents and other insurance industry professionals throughout the country, and support them through their sales efforts and administrative efforts, their employer clients as well as their individual clients. Work with a number of different national insurance companies such as Aetna and United Healthcare. With Benefits Administration Department, we operate at a third-party level and support employers with as few as 2 employees to as many as 30,000 employees, and help them administer various products such as flexible spending accounts, health reimbursement arrangements, and health savings accounts. We have debit cards available for those purchases. We do have what we refer to as cross-tech, which is some integration with several different insurance companies where we actually get claims feeds and then automatically can trigger reimbursement to employees. We have thousands of clients nationwide. In particular, a new relationship we have. We're an HSA vendor for Healthcare Service Corporation, which is a parent company of Blue Cross in the states of Illinois, Montana, New Mexico, Oklahoma, and Texas, and we are an HSA vendor for them. When we send out a follow-up email from today's presentation, we recently conducted a survey and put together a report on FSAs, HRAs, and HSAs and the different trends and predictions around those products. And we're going to send you information about that report so you can review it and see maybe there's some beneficial information in there for you. Another service we expect to be announcing here in the upcoming weeks is a WRAP document service. This is a plan document service to help employers comply with the ERISA written plan requirements. Make sure that the proper disclosures under the ERISA law are included and met with the documents you provide to your employees. So be more information about that in later weeks. Exchange platform and marketplace services, we partner with a company called IX Solutions. And Solutions has 2 different exchange platforms, one referred to as IX Suite, which is an employee-based exchange. It provides an alternative to traditional group plans, a really ideal platform for smaller employers, fewer than 50 employees, as well as larger employers who offer a retiree plan to their employees. Store is really an exchange marketplace for individual consumers looking to buy health insurance and other insurance-related products. So that's an overview about Flex and what we do in some of our business segments. Before we segue into the presentation today that's going to focus focus exclusively on flexible spending accounts. I just have a brief disclaimer here. Material in this presentation has been prepared for informational purposes only and not be considered legal or tax advice. We just ask that before you act on any of the information or the material that you hear today, that you consult with your legal, accounting, or other professional resources before taking any action. All right, for the rest of our hour here today is going to start with some basic information that I imagine many of you are aware of. Give you a recap of just some general administrative requirements as it relates to the flexible spending account. So just a handful of slides on that, and then we'll get into what I'll say are the more current items that are impacting flexible spending accounts. So we're going to talk about the Affordable Care Act impacts. We're going to talk about a notice that was issued by IRS. We're going to talk about FSAs and revisit how Cobra applies to those accounts. In my opinion, I think flexible spending accounts are one of the hardest types of Cobra benefits to administer, as things work a little bit differently than Cobra does, for example, with a medical or a dental plan. Then we're going to talk about how a flexible spending account works with health savings accounts and or health reimbursement arrangements, and things up with some FSA trends and talk a little bit about the future of these accounts. Time permitting, we will take some questions at the end. So here with the recap of some general administrative requirements as it relates to the flexible spending account. I should say this presentation is designed to focus on the health flexible spending account. It will not talk about the dependent care flexible spending account. To the flexible spending account, we believe there's 5 key administrative issues as it relates to making sure your FSA is compliant with IRS and other regulatory standards. First is the requirement of maintaining a written plan document. The second is ensuring your FSA is reimbursing according to uniform coverage guidelines. The second is talking about plan eligibility as well as plan ineligibility. Make sure only the right people are enrolled in that plan. Talk about some non-discrimination guidelines, ensuring that your FSA is not structured in a way that's benefiting highly compensated or key employees more favorable than other types of employees. And then a little bit about the claims that have to be substantiated upon receipt of a claim from an employee. So it's to the flexible spending account plan documents. This is key. Without the plan document, you technically, under the regulation, don't have a flexible spending account. So law requires employers that have an FSA to have a written plan document in force that describes things such as eligibility for coverage, which expenses are eligible for reimbursement, how claims processes work and claims appeals, and so forth. This plan has to be officially adopted, implemented at least 1 day prior to the first day of the plan year. Now, it's up to you on how you want to structure your plan document. This can be an independent document that is specifically about the flexible accounts, or it can be integrated with other plan documents. A lot of employers have a cafeteria plan in place, and that cafeteria plan includes details about the FSA as well as other items. Or you may choose a different type of plan document, such as an ERISA wrap plan document. Does matter to me which route you choose, that you choose one so that you are compliant with those relations. As an administrator, we do provide the appropriate plan documents to comply with the IRS requirements. Administrative concern is the uniform coverage rule. Make sure the FSA you have in place is reimbursing according to this particular rule. Now, employees generally make contributions to their FSA is on a prorated basis through salary reduction throughout the plan year. So, example, if there's an employee named Bob and he decides he wants to put $200 to his FSA, and Bob works for a company that has 24 pay periods throughout the year, Bob's going to have $50 deducted from each of his paychecks throughout the course of the year. Under the Uniform Coverage Guidelines, health FSAs are required to make the annual election available to that employee on the first day of the plan year. Assume Bob's employer runs a standard calendar year FSA plan. Then Bob's entire $1,200 FSA election must be available to him for reimbursement as of January 1st. even if he has not yet maybe contributed any payments to that FSA. So one of the big requirements in making sure your FSA is complying with the appropriate rules and regulations. To eligibility, there's employer eligibility and employee eligibility. So in terms of who can actually sponsor and offer a FSA to their employees, that's any employer, period. So for-profit, non-profit, S corporations, C corporations, partnerships, it does not matter. And in terms of who can participate, we used to always say, well, any employee is eligible. Any common law employee can participate in the FSA. Well, now done an IRS notice, it's any employee who meets certain standards. So we're going to talk about that in a few slides. One key point to take away is that anyone that's considered to be self-employed or who is a non-employee that is in some way associated with the employer, they're not allowed to participate in the FSA. So, an example, self-employed, this is a partial list, not an all-inclusive list, might include a sole proprietor, a 2% shareholder in an S corporation, a partnership, or in an LLC. So, large self-employed is going to be your business owners. The U.S. regulations state business owners are not eligible to participate in an FSA because they are taxed differently than other non-self-employed individuals. Non-employees are also not eligible, seems to make sense, but sometimes there's a board member on the board of directors, possibly all of the board members, that are associated with the employer, but they are not actually employees, and if they're employees, then they're not eligible to participate. We get a lot of questions around 1099 contractors, and if they're an independent contractor, they are not an eligible person, and that's because they are actually classified as self-employed. So we can put them in both of our buckets here that's on the screen. And then the dependents are not eligible to directly participate in the FSA. They can, of course, elect coverage for themselves and choose to use that FSA to reimburse their dependent, such as their spouse or their child. Non-discrimination, when we talk about the FSA specifically, there's really two sets of non-discrimination testing that come into play. The first are tests that are specific to the FSA, and then the second are tests that apply more globally to the cafeteria plan as a whole. And the general rule of thumb around the non-discrimination tests are that the plans cannot be structured in a way that would discriminate in favor of highly compensated or key employees. And if the plan is, then those highly compensated and or key employees lose the tax-favored status of participating in the FSA. So about non-discrimination, there's really three key areas that are looked at. Benefit design. Are the highly compensated or key employees offered a better benefit or a richer benefit package? Maybe the FSA, they can contribute more to the FSA than other non-highly compensated or non-key employees. In terms of eligibility, are enough non-highly compensated or non-key employees eligible to participate in the FSA? And then actual utilization. Who's acting coverage? So let's assume all things are equal and fair and everybody can participate. If the plan is skewed where that the enrollment into the FSA is mostly highly compensated or key employees, then you're going to fail the utilization non-discrimination test. An important point to note out about non-discrimination is that the testing must be done at the end of the plan year to assume that the testing is passed once all claims have been processed. So a plan may start as non-discriminatory but end as discriminatory. And the general rule of thumb that we recommend is that the plan should be tested throughout the year. The tests are rather complex, and the larger employer you are, the more complex the tests become because of all of the data that needs to be collected and analyzed. And that's why you might want to look into a third-party administrator to help you with those non-discrimination tests. The administrative issue I want to discuss is the claim substantiation process. The law says somebody other than the employee has to substantiate the claim, meaning they have to verify that the claim is a qualified medical expense eligible for reimbursement. And there are 5 core elements of the substantiation process. Employee or their covered dependent must show a proof of when the actual claim was incurred to make sure it was incurred during the appropriate plan year. The claim substantiation process also needs to identify the name of the person for whom received medical treatment, so we need to make sure it is an eligible individual. As an example, a domestic partner is not eligible for reimbursement under an FSA, so we need to make sure that the appropriate people are being reimbursed. The final expense from the employee, the total out-of-pocket cost after insurance or other types of payments. Need to know information about the provider. Only licensed medical providers can generally provide medical services that are eligible for reimbursement. So make sure it's a doctor, a hospital, a pharmacy, or some other licensed professional. And need to know service details. What exactly was the medical expense, and was it medically necessary? So, sorry, I jumped the slide there. In terms of the claim substantiation process, employees can do this in one of three ways, and of course these three ways also have to be allowable under the employer's FSA plan. But there's a paper form where an employee fills out a form and includes that information and provides any supporting documents. There'll be a lot of electronic data transfers. As I mentioned, we have integration with several insurance companies with automatic claims feeds from them upon an employee receiving medical treatment, and that prompts a reimbursement on our end. You can use a debit card, assuming the vendor that you're working with, if you are outsourcing FSA administration, has the debit card capabilities. Once the necessary information has been received, the claim can then be substantiated, and reimbursement can be processed. Understand when you have a debit card, there's actually not a reimbursement because payment was actually made at the time of service. But because payment was made, that doesn't necessarily mean that the employee doesn't have to still substantiate the claim. Oftentimes, additional information is needed from the employee, verify the service and that it was medically necessary. Your core sort of recap of general administrative requirements. I assume many of you are familiar with some of those requirements. If not, hopefully that was some good, helpful information for you. But now I want to migrate and talk about things that are a little more current, things that have happened over the last year or the last 2 years, things that are relatively new. And I'm going to start with some of the changes in the information that has resulted from the Affordable Care Act and how it has impacted flexible spending accounts in particular. So first, in terms of direct impacts, there were two primary changes that the Affordable Care Act imposed on flexible spending accounts. So first was over-the-counter drugs, things like Tylenol and NyQuil and many other types of over-the-counter drugs, Advil, those types of things. Prior to 2011, an employee could go out and purchase any of those items and it would automatically be an eligible expense. Well, into the Affordable Care Act, employees now must have a prescription from a medical provider for those over-the-counter drugs for it to be an eligible expense to be reimbursed. So while those items don't need a prescription to actually be purchased, they do need a prescription for it to be a tax-free reimbursement. I know there are some bills that are being introduced that would repeal this. I'm not sure of the likelihood of if they will or won't get passed. But for now, since 2011, this is the FSA has to operate in order for an over-the-counter drug to be an eligible expense. And the other big change from the Affordable Care Act was a change to the salary reduction limit. The Affordable Care Act says the max an employer can allow an employee to salary reduce through their FSA is $2,500. That number is adjusted for inflation. Right now, the maximum is $2,550. Due to inflation in the country, it's expected to remain the same in 2016, although we won't know for certain until the IRS issues some language around that. Now, these are the salary reduction maximum limits. As an employer, you are able to set limits lower if you have a reason to do so. Understand those are the IRS statutory limits. Now, here's an indirect impact that resulted from the Affordable Care Act. Prior to the $2,500 salary reduction limit, employers used to be able to set their own ceiling for flexible spending account elections. We had some employers that would go as high as $1,000 or $15,000 that they want an employee to elect into their FSA. And now, of course, they're capped at those lower thresholds, $2,500 adjusted for inflation, because it is the federal law now. And in the FSAs were designed, we use the term use it or lose it. Unused balances at the end of the planned year had to be forfeited. The IRS really had a concern with the ability of allowing employers to have their own maximum ceilings. They were concerned with employees deferring compensation, avoiding taxes for the whole purpose of delaying when they had to pay their state and federal income taxes. So that's why they had this use it or lose it rule. They didn't want people to sort of game the system and get a tax benefit around that. So now that there's a lower limit, a $2,500 limit, they're not so much as concerned about employees delaying their tax obligation and deferring compensation for no valid reason. So they've got a lot less worry around that, and as a result, they implemented a limited rollover provision. That rollover provision is a maximum amount of up to $500 in unused funds, can be carried over from one policy or plan year to the next. This is an optional provision, so as an employer or a benefits administrator, you can choose to have this or you can choose not to. I can tell you have thousands of FSA clients, and 95% of our clients have adopted the rollover. Others don't have it in place for one reason or another. Understand that if you do have rollover or something you don't have now but you'll be implementing in the future, your plan documents must be amended to include language around the rollover provision and how that works. Understand also that if you do have the rollover, you must not also have a grace period. Grace period is an FSA term where claims can continue to be eligible for dates of service up to 2.5 months after the conclusion of the plan year. So as an example, if your plan year was January 1st to December 31st, you can have eligible claims from January 1st to the following March 15th. The IRS says you can only have grace period or rollover, not both. And similarly to amending your plan documents to permit rollover, if plan had grace period, you must amend your plan document to eliminate grace period. That makes employee elections a little bit easier because they don't have the huge concern of having unused funds that they forfeit at the plan year, so they don't have to be as conservative or try to be as specific to the exact amount of medical expenses that they incur from one year to the next. That really does ease that process. Talk about flexible spending accounts as it relates to IRS Notice 2013-54. This notice is not directly wasn't a part of the Affordable Care Act. As a result of different things that were going on in the industry related to the Affordable Care Act, the IRS did issue this notice, which was very impactful to cafeteria plans, to flex spending accounts, and health reimbursement arrangements. So we'll talk, of course, specifically about the FSA impact. So this was issued on September 13th, 2013, Friday the 13th, and it imposed some requirements on FSAs. It does 10 years on or after January 1st, 2014. One of the first impacts is that it requires FSAs to be earned through a cafeteria plan. Most employers do offer the FSA through the cafeteria plan, but in some rare limited situations, we've crossed employers that offer FSAs outside the cafeteria plan, or the employer doesn't have a cafeteria plan in place. And excuse me, the new say, if an employer does not have a cafeteria plan and they offer an FSA, the FSA must not have any annual dollar limits. As an ACA provision, for example, on health insurance plans, the insurance plans cannot limit an annual dollar amount for any potential health benefits. So For example, a plan can't say, well, hospitalizations, but only up to $50,000 per year. Hospitalization benefit would have to be covered with an unlimited annual benefit. And the IRS notice says that if your plan isn't offered through a cafeteria plan, then you have to comply with that annual dollar limit. And that's not the way FSAs are structured. You know, they're structured generally to be capped at maximum payout of what the employee's salary reduction would be. So, as a result, if it's not offered through a cafeteria plan, it must comply with the annual dollar limit, but most employer FSA plans wouldn't. So have an FSA that's out of compliance, and that could trigger a penalty of $100 per employee per day. Now, that's a big, scary number, but this is probably not going to be a big deal for most of you that are offering an FSA on the call here today, because in all likelihood you are offering it through a cafeteria plan. If you're uncertain, you might want to do some double checking, and if you're not, you might want to consider making sure in the future it is offered through a cafeteria plan. Now, the second provision of the IRS notice that was impactful to FSAs, the requirement for an FSA going forward to meet the definition of a term accepted benefits. Now, this might be a little bit of a bigger deal for some employers who are unaware of what an accepted benefit is. And so I want to talk about that in terms of its definition. Benefits that are generally exempt from the Affordable Care Act's market reforms. And that they fall into one of four buckets. They're considered not a health plan, such as disability insurance plan. It's offered separately from the medical plan, such as a standalone dental or a standalone vision plan. It's not coordinated with the medical plan, such as a critical illness or a cancer plan. Or it's a benefit that supplements the Medicare plan. And the best example there is a GAP plan or a Medicare supplement plan. So the law says an FSA somehow has to meet the definition of an accepted benefit. Other all these rules and regulations from the Affordable Care Act, in addition to the ones we've already discussed, start to come into play. The law says an FSA can meet the definition of an accepted benefit. It has to meet two specific conditions. The specific condition is the availability condition. And the availability condition is pretty simple to understand. If parties are offered other major medical coverage by virtue of employment, the availability condition will be satisfied. It means if you have, for example, part-time employees that are not eligible for the medical plan, that means those part-time employees are not eligible for the FSA either. Otherwise, that availability condition will be satisfied. Then we have the maximum benefit condition. The condition is a little more complex. It says the maximum benefit payable to a participant can exceed 2 times the employee's salary reduction, or, if greater, $5 plus the amount of the employee's salary reduction. And every time I read that, I think it's a little bit confusing and hard to understand. So I like to try to break that down in layman's terms. Really what the maximum benefit condition means. There's only a concern if an employer is also making contributions to the FSA. We don't find that to happen too often, but definitely in some circumstances it's applied. So just employee salary reductions, you're satisfied the maximum benefit condition. But the minimum benefit condition can be satisfied if one of 3 circumstances applies. First, you mentioned the employer does not make any contribution to the FSA. Second, if the employer makes no more than a $500 contribution, that satisfies the maximum benefit condition. If the employer makes no more than a dollar-for-dollar match, would satisfy the maximum benefit condition. So, meet the availability condition and one of those 3 requirements from an employer contribution perspective. Let's just put a couple examples here of what's okay and what's not okay. So we here named Judy, and Judy decides she wants to salary reduce $15 into her FSA, and Judy's employer is going to match her contribution. So she's got $1,500 through her own salary reductions, plus $1,500 from her employer contribution. Judy has $3,000 in her FSA. Some people, the limit was $2,550. It's $2,550 for a salary reduction. And if you look at the maximum benefit condition, it says the maximum amount that can be reimbursed is up to 2 times the salary reduction. So in scenario, it's exactly 2 times the reduction, and that's okay. Example 2, we've got William, and he decides he wants to put $300 into his FSA, and his employer is generous enough to give him an extra $500 on top of that. So more than his salary reduction, but it's more than $500. So that's okay. In this scenario, he's got $800, and that's okay. But he's not okay. For an employer, and she decides to put $600 into her FSA. Barb's employer wants to put $1,000 into her FSA. More than twice her salary reduction. That's more than first. She's got $1,600 here total. That's not going to be okay. The maximum benefit condition would be failed. And for Barb, that would mean all of the Affordable Care Act, or I shouldn't say all, but most of the Affordable Care Act market reform provisions start coming into play. So that would be a big concern for an employer. So want to make sure these conditions are being satisfied. In terms of accepted benefits, the early and maximum benefit condition must be reviewed for each participant. And again, it'd be very simple if there's no employer contributions to know if it's a pass or fail. But if there are some employer contributions, want to make sure you're within the accepted benefit guidelines. And if an FSA fails to meet one or both of those conditions, I mentioned the market reforms start to come into play. As an example, the FSA would have to cover preventive care services at 100% with cost sharing to the member. So physical exams, cancer screenings, those types of things, the employer would have to pay the full cost of that without impacting the employee's maximum reimbursement amount. So that would be a huge issue. And FSAs, I can't find any scenario where an FSA would be able to satisfy all of the Affordable Care Act requirements. So if it's not accepted benefit, a non-compliant FSA, that $100 penalty per day per employee, $36,500 maximum penalty. I don't think that's what employers are signing up for here. So want to revisit your FSA and make sure it is listed as an accepted benefit. Talk about flexible spending accounts and how it interacts with Cobra. This isn't something new, but very, very unique how FSAs interact with Cobra. And I see a lot of confusion in the marketplace about Cobra and FSAs. So when it comes to FSAs, there's what I refer to as a limited Cobra provision that applies, where you have to offer Cobra for the same amount of time you might have to offer Cobra to for all types of plans like the health insurance plan. But it only applies to the flexible spending account. Number one, if it meets the definition of an accepted benefit, and number two, if it meets what is referred to as a premium condition. So now about Cobra, we want to make sure availability condition is satisfied, maximum condition is satisfied, and now we have the third condition, the premium condition. Pretty simple to understand, and most FSA plans under Cobra are going to satisfy this. So the premium condition is simple. It says the premium for the FSA must be equal to or greater than the FSA annual election. And premiums are paid on a month-by-month basis. So let's say Joe works for an employer and collects $1,200 on an annual basis. As long as Joe's premium it was Cobra eligible, he quit his job, he was terminated, or some other circumstance, as long as Joe's premium was at least $100 a month, that premium condition is going to be satisfied. And that's really the standard way an employer will calculate the premium. Take annual election, divide by 12. You can still add up to a 2% administrative cost on top of that, so you could charge anywhere between $100 and $102 per month in this scenario. And to do that, you're going to satisfy the premium condition. Most FSAs out there satisfy this. We administer Cobra on a national basis, and this is really how all of our premium conditions are set up. To have the annual election divided by 12 that helps us determine the payment, and add on a slight administrative fee for the administrative processes. So most FSAs are going to satisfy that, and therefore most FSAs are going to qualify for limited Cobra. So what is limited Cobra? Well, the Cobra regulation issued by the Department of Labor says Cobra only needs to be offered to FSAs if those FSAs are deemed to be underspent. What does underspent mean? Well, are considered underspent if total reimbursements are less than year-to-date salary reductions. As an example, we've got Mike, who works at an employer, and through a portion of the year, Mike has had $400 in salary reductions taken out of his paycheck, only been reimbursed $100. So that would be considered underspent. If Mike had been reimbursed more than $400, his account would be overspent. And if an account is overspent, then Cobra doesn't even have to be offered. If a plan is not an accepted benefit, and or the premium condition is not met, then regular Cobra is going to apply 18, 29, or 36 months, depending on the particular qualifying event and whether or not the employee has a disability. So when I talk about limited Cobra, I forgot to mention, if you qualify for limited Cobra, then Cobra only has to be offered through the end of the plan year, not your 18, 29, or 36 months. So only has to be offered through the end of the plan year. So that works a little bit differently than a medical plan or a dental plan or a vision plan or an HRA for that matter. So let's migrate now to talking about FSAs and how they interact with health reimbursement arrangements and savings accounts. We get a lot of questions about, can I be in both or one or all, and what information do I need to know about that? So we'll talk about, can an employee have a flexible spending account and also make contributions to a health savings account at the same time? And of course, to be eligible for a health savings account, you have to meet certain criteria, such as being enrolled in a qualified high deductible health plan. You also must not have other disqualifying coverage. And your traditional general purpose FSA is going to disqualify an employee from being eligible to make contributions to an HSA. So the HSA has to be structured in one of two unique ways to have both plans and make contributions to HSA. One, and it's the most common way that we see, an FSA must be what we refer to as a limited purpose or a limited scope FSA. Limited purpose or limited scope FSAs, two synonymous terms, are FSAs that only reimburse dental or vision expenses. Second, the FSA, if it's structured to be what we refer to as a post-deductible or an after-deductible FSA, that would be an eligible requirement to have both the FSA and the HSA at the same time. And when I say post-deductible, it means the FSA won't provide reimbursements until after the plan deductible has been satisfied. Now, technically speaking, in order to have an HSA plan, you have a plan with at least a $1,250 deductible as a single or $2,500 deductible as a family. And as that FSA won't provide reimbursements until those thresholds are hit, you're going to be okay. So it's not necessarily the actual plan deductible, but it's post-deductible in terms of you've satisfied the minimum IRS statutory deductible limits. Your FSA, as long as it's kicking in after $1,250 or $2,500, you're going to make contributions to an HSA as well. Now, oftentimes we get asked, can an employee have an FSA and also a HRA, a health reimbursement arrangement? This is a little simpler, not as many restrictions here, actually none. The simple answer is yes. The employee can have both, and the employer determines the ordering rules, which plan would reimburse first and which plan would reimburse second. So that be identified within the employer's plan document. And the big question, can employees have all three? Can they have an FSA, an HRA, and HSA all at the same time? And the answer is yes. It's really the HSA that has restrictions because they need to have a qualified high-deductible health plan and no other disqualifying coverage. As long as your FSA and HRA were either both limited purpose or both post-deductible or some combination of those, then you would be okay. So as an example, I actually am enrolled in all three of these plans here at my company. I have a high-deductible health plan. My employer has an HA that pays my coinsurance after my deductible's been satisfied. Also set up an HSA to help pay on a pre-tax basis for my deductible, and I do have a young child who has some dental expenses, so I enrolled in our limited purpose FSA for dental reimbursements. So I think that's advantageous to me because I get the advantage of tax-free reimbursements for free accounts, and I have no disqualifying coverage that would prohibit me from putting and making contributions to the HSA. So sort of wrap things up here with talking about some trends and future predictions as it relates to flexible saving accounts. And as mentioned, we did a survey this past summer, had more than 500 employers and HR professionals working at employers respond to different questions we had about employers and the types of plans offered, the types of reimbursement plans in particular, FSAs, HRAs, and HSAs. And I got some interesting results, I thought. So we simply asked employers, what do you offer an FSA? Do you offer an HSA? Do you offer an HRA? And an overwhelming number of employers, as you can see, are offering an FSA. Based on our survey, 90% of employers are offering an FSA to all some portion of their employee population. FSAs were the second most popular, followed by HRAs. We want to break it down a little further, so we said, hey, do you offer more than one medical reimbursement plan? Do you offer an FSA and an HSA? Or offer all three? Or what are different variations that you offer? And you can see FSA on a standalone basis was the popular option at 47%, but outside of the standalone HSA, the FSA was offered in combination with one or both of the other reimbursement products. So you can see the FSA is really being included in the vast majority of employer offerings. And then a little further to see, are there any variations by employer size in terms of what they offered to employees? So we started with smaller size business segments and then moved up to the larger size business segments. But one of the things you can see that stands out to me is that the standard FSA was the most offered benefit among all employer sizes. The next screen here, this just continues to show employers of additional sizes, and FSA continues to be one of the most popular plan options out there for the medical reimbursement. So we sort of drew from a conclusion from our survey was FSAs are probably close to their maximum market penetration in terms of the number of employers that are offering this type of arrangement to their employees. So sure, it could go up another percentage point or two, but 90% is probably close to the maximum that we're going to see through our lifetimes here. And while we see offer rates high, FSAs have been around for 40 years. That's part of the reason that employers are offering them. They've been around longer than HSAs and longer than FSAs. FSAs are, and it's not just FSAs, but FSAs are facing a threat by what's referred to as the Cadillac tax. And I'm sure many of you have heard about the Cadillac tax. Many of you might even be experts on the Cadillac tax. But just to give you sort of a rundown, a brief rundown of the Cadillac tax, It's a provision that was included as part of the Affordable Care Act. Its intent is to discourage really rich benefit plans that might encourage overutilization of medical services, so treatment for things unnecessary, discouraging plans that might drive somebody to go see the doctor for every minor bump and bruise that needs to be put on. So that's intent to try to slow or eliminate, reduce unnecessary overutilization of medical services. And it's supposed to take effect in 2018. There are a lot of advocates against Cadillac tax and lots of efforts to make changes to the law, to have it delayed or to have it repealed. So uncertain what will happen with those efforts. The tax in general will impose an excise tax of 40% for use of coverage that exceed $10,200 for singles or $7,500 for families. Numbers will be adjusted for inflation, and there may be some variations to them as well for things like employees who operate in a high-risk profession. And numbers look big when I look at them. Wow, $10,200 value of coverage, $20,500 for families. It's going to be hard for an employer to hit those thresholds. But when we start to take a look at some of the IRS information that's been released, they include a lot of employee benefit plans in numbers. As an example, they're going to include the total medical premium, both employee and employer contributions for a health insurance plan. The average health insurance plan is getting close to $7,000 for single, and about $17,000, $18,000 for family coverage, the average. But it's also going to include things like FSA contributions, both from the employer and the employee. FSA contributions will be rolled up into those thresholds. HSA contributions made by the employer, and also employee salary reductions to HSAs. IRS is going to include on-site medical clinics. It's hard to determine, well, what is the value of an on-site medical clinic? And Future Guidance will help us include that. But you can see they're starting to include a lot of plans. And their Family Foundation, a very reputable resource in the industry, providing lots of details and statistics about different employee benefits and impacts of different regulations. They recently released a report that said, the medical plan alone, absent any changes, probably trigger the Cadillac tax with about 16% of employers, 16%. He said for employers that offer a medical plan and an FSA, that jumps to 26%. So the threat then is, what are employers going to do? How are they going to react? Are they to eliminate the FSA, or we cap the maximum salary reduction at an amount that's less than what the IRS statutory limit allows? No. So there are efforts to try to get that FSA excluded from the value of coverage. Again, certain how successful those efforts will be. Most recently, the IRS issued a notice. It was on July 30th, referred to as Notice 2015-52. This second notice released this year in regards to the Cadillac tax. I really encourage you to do an internet search, find this document, take a read of it. I think it's about 16, 17 pages in length, but it talks about a number of different issues relating to the Cadillac tax, and it's seeking public comment. So if you might be adversely affected by the benefit structure you offer, and might be in a position where the Cadillac tax would come into play either in 2018 or at some point thereafter, it might be beneficial for you as an employer or an HR professional to submit comments to the IRS about how you think this law should be rolled out. And at some point, after reviewing these public comments, the IRS will formally propose regulations about the Cadillac tax. Right now, just releasing information about the process in developing regulatory guidance. That being said, That draws me towards the end of my presentation. So number one, want to thank you for your time today. I hope at the very minimum you at least picked up one new piece of information. What we're going to do for you is in the next 2 to 3 business days, we're going to send out the HRCI General Recertification credits. We'll also send out the SHRM Professional Development credits. We will include a PDF copy of this presentation and that survey that we recently did, and we put a report together referred to as FSA, HRA, and HSA report trends and predictions. We'll include a copy of that. So you're going to get a few different items from us. Hopefully that information will be useful to you, if not immediately, at some point in the near future. So that being said, I do have 8 or 9 minutes left. Open it up for questions. Again, we're going to keep phones muted here today. And if you do have a question, please go ahead and use the chat function or the Q&A function, and I will go ahead and answer as many as I can here. So just questions, a lot of questions just asking if you could have, if we're going to send copies of the presentation. Absolutely. There is, if insurance premiums are eligible under a flexible spending account, and the law says no, insurance premiums are not an eligible expense under an FSA. You know, whether it be insurance premiums for the employee or their spouse or dependent children, and that's regardless of whether it's an individual plan or a group plan. Great question. Relating to the FSA accepted benefits, what happens if the employee waives medical coverage but enrolls in the FSA? Nothing. That's perfectly fine. They just have to be offered medical coverage, major medical coverage. They don't have to enroll in it. And if they're offered it, the IRS says that is considered an accepted benefit. Around our administration and if we offer limited Cobra, the answer is yes, we do. We actually find very, very few employees actually elect the FSA for Cobra. It's typically just the medical, maybe the dental and vision. It's not an automatic. We just need to have correspondence with the employer at the time of the Cobra qualifying event. So no, nothing to sign up for. What is the benefit of having both an FSA and an HSA at the same time? And it's the tax savings. That would be the benefit. If it doesn't make sense for an employee, they're not expected to incur medical expenses, or they don't want to sit in their HSA long term, they don't have to have both. They choose whatever option is available to them and that meets their needs. Students just asking for confirmation that the FSA contributions are going to be included in that Cadillac tax. According to the 2 IRS notices, it looks like, yes, they are going that way. I mentioned a few slides back. Absent any changes to their thought process, at least for now, it looks like that's the route they are going. There's about websites to reference the total value of the Cadillac tax. I don't know of any websites in particular, but you'd want to reference at least that notice. The notices are partly used to tell you how they're going to how to calculate the value of coverage, and some of it is still unknown. You know, there's no formal regulations yet on the Cadillac tax guidance. Just to get 2 IRS notices that are seeking public comment to really help them in identifying what is the best way to add the value of coverage. So other than the notices, I'm not aware of any website specifically. About the FSA plan document and referencing it in the plan document would satisfy the plan requirements. The answer, no. ERISA has a number of different things that have to be disclosed in your wrap document, and as long as all of those disclosures are met, that would suffice. Sometimes with a TPA, for example, we do issue a rather in-depth plan document for the flexible spending account. That wrap document will generally just advise the employee to reference the plan description that has been provided by the third-party administrator. So, yes, the answer is yes, but you got to make sure all of the appropriate disclosures are in there if you don't have a separate summary plan description. One pay for a supplement policy like a cancer plan with an FSA, insurance premiums are not eligible. They're in about FSA and orthodontics, and there is a unique provision specific towards orthodontia. Under most FSA medical expenses, you cannot get reimbursed until the actual date of service. But with some orthodontists, they'll have a payment plan or a payment made in full up front. You might be able to get reimbursed prior to the actual date of service. That really is up to the employer to decide. It's not a requirement to have the FSA reimburse the orthodontia for the actual service being rendered. As an employer, you can allow it. So it's really up to you as the employer, and if you're working with a third-party administrator, if their procedures allow. So, question there. Another thing, you pay Cobra premiums through an FSA. No insurance premiums, again, permissible under the FSA. Well, I'm about 2 minutes early. Again, we will get copies of this presentation out to you along with some additional information here shortly. I did not get to your question. There are several that came through. I'm going to print out these questions to see if I think we addressed them all. If not, either myself or somebody else, I'll do our best to follow up with you. But I want to thank everybody for your time today. Hopefully, again, you at least picked up one new piece of information. We will have some additional webinars on various topics through the end of this year and into next year. So be looking out for some emails on those, and hopefully we'll be able to provide some more information to you in the future. Thank you very much, and have a wonderful day. Take care. Have a great rest of the year.